Hello and welcome back to the Note. Well, the Nasdaq Composite is back below 5,000 today. It's still only 3 days in history when it's been above that number, but I am prepared to predict that it will be less than 15 years before it gets back above 5,000 this time. Now, that was part of a general bad day for stocks across the world. Meanwhile, the dollar is strong. It's at a new high for the year and therefore a new high for more than a decade. And bond yields have also been rising today close to their highs for the year. Now that plays into a very interesting effect for the stock market, which I'd like to show to you. Let's start by taking a look at the S&P REITs index, real estate investment trusts, relative to the market. And you can see that their performance is remarkably tightly linked to the bond market. They're regarded as a bond substitute by many, paying a high and relatively predictable cash yield, and you can see that they really rallied in the months that bond yields tanked, and that there has been a very sharp turnaround in the last month or so as bond yields have begun to rise again. Now let's take a look at that over a longer term perspective with another sector that's regarded as a bond substitute, which is utility stocks. Again, high dividend payers, and you can see over 2 years again a remarkably clear link. Utility stocks do well when bond yields are falling. Once bonds begin to offer a more appealing income, utility stocks sell off. What do we make of this? Well, if the market continues to be right that the Fed really is going to raise rates later this year, even as so many others reduce their rates, obviously you'll see more dollar strength, but you will also see higher yields, and that will mean interesting collateral effects in the stock market, particularly for bond substitute sectors such as utilities and real estate.